Thank you all for being here. I'm like Nancy. I'm greatly appreciative of the fact that you guys are willing to brave the traffic in Silicon Valley to be here. We'll try to make it worthwhile. Let's see how we do. First, today's discussion is about ESG. And when I talked to several of the people that I know in the Valley board members, I said the word or the acronym ESG, and I got a bunch of eye rolls from some of them. I did some research before we did this event, discovered that there are 41 seminars, conferences, and events being held in Silicon Valley in October and November on the subject of ESG for executives, for attorneys, for members of audit firms, big four accounting firms, big three, I guess now. And so having that as prelude, our focus today is going to be quite different, as you'll see in a minute. And our focus is going to be on asking experts, and the three people on my left are certainly that. Marcia Vandenberg, Alan Seam, and Colleen are going to talk to us about what the practical aspects of ESG are for public company boards in Silicon Valley, which is to say, this is not about virtue signaling. This is about practically bringing ESG where it belongs and bringing the elements of ESG to actual practice within a public company board. So let's see how we do today. As I mentioned, I'm going to ask each of my panelists to introduce themselves, starting with Colleen, and then to Alan, and finally to Marcia. Colleen?
So, hi, everyone. Very nice to be here today. So I'm a professor at Stanford Law School. I teach securities regulation, accounting for lawyers, and then also corporate governance. I'm also on the SEC's Investor Advisory Committee. So I do a lot of work with ESG related topics, and especially with, on the sort of financial regulation side and how that interacts then with ESG reporting.
Great. Wow. I think I should have taken your classes when I was in law school. So I'm Alan Seam. I'm a partner in this office of DLA Piper. My general area is corporate law. The areas within that are securities law, capital markets, M&A, venture capital, and corporate governance, which is really the topic that we're going to be discussing today. I've spent my career as a corporate lawyer, but a big chunk of my career I actually spent in Hong Kong and China. And so I've worked with both foreign private issuer public companies. About 11 years ago, I moved to Silicon Valley. So I've been working obviously with public companies here in Silicon Valley in the US. And I also do work with private companies as well. So I look forward to speaking with you today.
I should mention that we are here in this beautiful facility thanks to Alan and his team. They did a wonderful job of putting us up and providing us not just a facility, but the means of making this seminar work. And now Marcia.
Great. Thank you, Mark. Marcia Vandenberg. I sit on a board that's in the financial services industry. And it is in Mumbai, India. I've been on that board since 2014. It is privately held, has a very strong ESG strategy. Can you hear me in the back? I needed the green. I had the red. Thank you. Sorry. So I sit on the board of a financial services company. It's located in Mumbai, India. They have a very strong ESG strategy, I'm very proud to say. And the board recently took itself through a risk assessment strategy having to do with ESG and prompted by our ESG interests. I'm formerly the CEO of Pacific Pension and Investment Institute, a membership organization of large institutional investors, many of which are in the vanguard of investors investing in ESG strategies. And I'm also a former Distinguished Careers Fellow with Stanford University, and I have one of my colleagues from the DCI program here in the audience, Britta Bombard. So thank you very much. I'm delighted to be here.
Wonderful. All right. And finally, I'm Mark Lonergan. I'm the founder, managing partner of Lonergan Partners, which is the largest independent executive search firm here in the Valley. Most people know us for our CEO work. And a couple of partners in the back, Tanya Mir and Kirsten Settle. Thank you for attending today as well. I was anxious to pump up the number of people who were attending in person, so I did what I could. In preparation for doing this panel, I did a lot of research, as you can imagine, on the subject of ESG. What's out there in the press, what's out there in popular literature and academic literature. Probably the most recent and most impactful study was the one that was only completed about 3 months ago by PwC. And it was a study that comprised something like 1,300 public company board members and asked all kinds of questions about ESG. ESG was emerging as a very substantial movement out of 2021 and 2022. And they wanted to know how current public company board members felt about the various elements of ESG. And I would say to you that the results were definitely mixed. Results were all over the map. Generally, and I did not put this in the number, 80% of public company board members believe that some elements of ESG should be incorporated into the activities of the companies that they serve. And so for them, it was understood. The question then became formal versus informal ESG programs, and you see the numbers right here. I won't kind of lead that through you. It turns out that diversity and the development of corporate culture were easily the highest scoring elements of ESG. Board members felt almost 9 out of 10 that those should be addressed by the board and part of the board's mission in serving the companies it's involved with. And 86%, I find this astonishing since most of them are still kind of feeling their way out on ESG, believe that they really understand the current ESG strategy of the companies on which they serve, which makes me wonder. I'll call that sampling error and we'll move on. There are some challenges around ESG. There are some things that advocates are going to have to address over the next several years in order to make ESG a more fundamental part of the board's agenda. And the first one of those is spelled out in the sense that if you don't see a connection between corporate strategy and your ESG implementation, you're going to be reluctant to push forward ESG as an initiative, as something that's important to you. You're going to have to make the case that things like climate change, human rights, corporate political activity are a meaningful and appropriate part of the corporate's board agenda. Right now, 3 out of 4 currently seated board members don't feel that those things belong. And then I found the last one the most interesting. Not surprising, male directors and female directors have a different list of what they consider to be ESG. You can imagine that things like climate in particular is probably number 1 among that list. Female board directors feel much more strongly about climate change and climate issues and are anxious to address that through their ESG programs than their male counterparts. For those of you who haven't seen it, I would encourage you strongly to take a look. The PwC study really is seminal, and it helps a lot of people understand kind of not just where ESG is now, but where it's going. I only quoted a few of the highlights. So what's our goal for today? Look, we have an hour and a half, and we're not going to get to all of it, so we'll do our best to get through the parts that seem to make the most sense. Number 1, we want to know kind of how to make ESG practical, which is to say, the old adage, the way you eat an elephant is one bite at a time. How do we consume ESG? If we're to consume ESG at all, and some of the people, if you guys follow the PwC model, may not agree that ESG is important enough to be tackled by corporate boards. That's something that we can talk about with the panel. Secondly, no matter how people feel about ESG today, it's clear from my study of the topic that there are regulations coming at the state and even at the exchange level. The SEC, NASDAQ, New York Stock Exchange have invoked regulations and recommendations that will change the nature of ESG and its implementation in the companies that you serve. Third, talk about ESG and what happens when you do an ESG program, even one. By the way, the first question we're going to start with, ESG is a really big topic. It doesn't mean anything except that it's an easy way to hyphenate a whole series of topics and issues that involve ecological, social, and governance impact. And so the question of what are the practical elements that can be incorporated and should be incorporated and how to do that is something we can address here today. And then finally, and then maybe this is the most important to me, I'd like to give you as board members, as executives in the community here, something that you can carry into your next board meeting. Hey, here are 2 to 3 things that I've learned about that we can perhaps, get involved with. These are things that are going to make us a better board, a better company, a better contributor to society. And if we can do that, if that's part of our discussion today, then I'll feel like we had a pretty good discussion. So that's it. And with that, can everybody hear me okay? I'll switch microphones and we'll kind of go to this format. And I'm going to start with the most basic question possible, which is, what is ESG? And that's, at one level, a simple question and a not so simple question. But Marcia, I see you smiling, so I'll look at you first.
It's always a mistake to smile in a panel like this one. I'd have to say that ESG is a troubling concept. I mean, it is very, very big. It is not a unitary concept. It really is a combination of things. And for me, I boil it down to risk. It is a set of risk factors as opposed to I think you called a virtue, something that proposes virtue, but it comes down to really risk factors. It's a way of assessing risk. And in this increasingly complex world that we live in, Mark, I think we have to begin to look at it in terms of that, through that lens of risk, as opposed to impact/virtue. That happens, that's part of it, but I really see it in elements of risk.
Sure. Colleen, what are your thoughts?
Sure. So, I mean, I didn't mention about my background also, but I did a PhD in accounting, or as my mom tells people, bookkeeping. So I do tend to see things from like the lens of an accountant. And when I think of ESG, I really think of where does GAAP leave off? So, and what sort of intangibles are not actually captured by GAAP? So, for example, if you think of employee satisfaction, clearly that's valuable to a company if they have happy employees who are actually sticking around. Yet that's not the type of asset that would actually be captured on the balance sheet under GAAP. And so in my mind, and when we look at like the value of intangibles, I have a statistic. So in 1975, this was 2 years after the SEC adopted some rules just disclosing even like the number of employees that companies had. Intangibles represented 17% of the value of the S&P 500. By 2020, they represented 90% of the value of the S&P 500. So you've had incredible growth of intangibles that's represented in market cap, but that's not actually showing up in book value. So in my mind, when we're thinking about ESG, a lot of this stuff is things that is not, captured in book value, but is valuable to the company. And so I tend to see it from a lens of like intangible assets.
Alan?
Sure. All right. I have to go last, so everybody's covered all the good stuff. I think that, to Marcia's point, it obviously relates to risks, but it also, I think it also has to do with areas that a company can focus on, that its investors might care about that, as Colleen was saying, are not captured by the financial statements, right? It's, as she said, it's the intangibles. It's the accounting. It's the stuff outside of that might not be captured by the accounting. But I was also thinking when Mark asked this question, like, ESG, I think there's other words you could use to substitute that might make it easier to think about it. The E is, frankly, I think, as you see by most of the SEC rulemaking, it's about climate and climate change. A lot of the E is about that area, not all of it, but a lot of it. The S is really more about people, is how I think about it. It's not, people say social, what does that mean? But social is about people, how it affects your people, and how the people that your business impacts or is affected by, how they're impacted by what your company is doing. And the G, the governance, is really about the policies, right? What policies is your company implementing to address these types of intangible areas? So that's kind of how I think about ESG. But as Marcia said, it covers a huge umbrella of issues, and it's going to be, frankly, very different depending on the industry you're in and the company that you're managing. So it's going to have a different meaning, frankly, for every company.
There's an interesting phenomenon that I discovered in doing the research for this event, and that is that ESG was an almost unknown acronym before 2019, and really the second half of 2019. It had been introduced in Congress as a general area for study, and it has since taken off. And it's become a major topic of conversation in most boardrooms. That's clear. The question is, what's driving that? Why is that? Have boards kind of turned themselves on to the notion of implementing ESG in some form?
Mark, before I respond to that question, I just wanted to say something about the current state of play with ESG. And I really think we're talking about E and we're talking about S, and they equal the G. Governance is what happens as a result of management and a board's focus on the E and the S. And principally, E is front and center, and E only as it applies to climate risk. I mean, the water issues, unless you live around the Mississippi River, the E really applies to environmental climate risk. And that's where we see the focus of the SEC rules being proposed now. For companies that are looking at the quality of their workforce, I think the S comes into strong play there. Diversity in all ways, shapes, and forms, the ability to get talent in this very tight talent market that we have currently, but that ability to get talent, retain talent, the ability to take care of your workers, to really make them feel like they're part of a company, part of the corporate purpose. It really then comes down to the values of that company. But so I really think we have to unpack ESG and not get bogged down by the weight of the acronym, because it really is, in today's context, a focus on climate risk here in the US. Europe is a little bit different story, but then the S is also equally important.
I understand.
Yeah.
So why is it being driven so hard now? And why is it that, call it what you like, under any other term, why are those issues more germane to the board's role than it was in 2019?
I think in a single word, it's shareholders and investors. I mean, it was probably post 2008, the global financial crisis, that investors really began to focus on the complexities of this world we live in, those intangibles in many respects of what are driving the ability to create value as a company. And they said there are things that are out there like climate change, like climate risk. And it was about that time that the argument that a heated planet was going to cause us big problems down the line was beginning to get traction. They were paying attention to that. And they said, we want more information from every one of the companies. We want to know what you're doing with specifics. We want that information. And if you think about it in terms of quality of capital markets and all that, that's, the more information, the better.
So
informed you have.
investors are driving.
Investors, in a word. Yes.
Alan, do you agree with that?
Yeah, maybe I'll try this microphone. How's that? Yeah, I would agree. I think investors have basically stepped into the void, that because there hasn't been regulation, particularly in the United States. It's really been driven by shareholders and investors. The U.S. I think clearly lags behind Europe in regulations relating to ESG, but the SEC has introduced proposed rules and is clearly going to be introducing more. So I think the regulators are going to start, taking over. I think some of the initiatives that these huge shareholders like BlackRock and State Street have been driving up until now. I think even with the new SEC rules, there's still a lot more that investors are asking companies to disclose that the SEC hasn't touched on yet. So I think a lot of it is, even after the new SEC climate rules become effective, which they clearly are going to at some point soon. I think a lot of it's, companies just need to ask themselves, like, what are their investors most concerned about? And we can talk about that later about, shareholder communications. But I think that's going to continue to drive a lot of the disclosure that companies are going to be putting in their public documents, and less so, I think, what's being required by the SEC.
I'm kind of struck by the notion that you started with this, Alan, that European companies are more tuned into ESG as a group than perhaps we are here, maybe because of regulation. Is that the model that we're likely to follow? That U.S. corporations will likely end up looking more like, and regulators will end up looking more like they are in Europe now?
That's a good question. I don't really know. But I think that, that we have the advantage of seeing regulations that are being put out in Europe, and then, the US government can decide, or not just that, the state governments as well can kind of pick and choose to say, hey, what's working, what makes sense, what standards are evolving. I think that's another big question that needs to, continue to be resolved. Is there needs to be some, coalescing around common standards, and that, that's already happening, but that needs to continue so that investors can compare apples to apples. Because if you have all these companies putting out various types of data that you can't compare, company to company, I think that's less useful to investors. But the difficulty with that is, as I said before, companies are all different, and so the data put out by one company may not make a lot of sense for another company. So those are issues that are going to continue to be discussed, and hopefully, as I said, try to get resolution towards some common standards that all companies can apply.
And Colleen, what's your thought about that?
So I definitely agree that investors are driving it. With that said, I think that begs the question, what's driving investors? And so, one option for that is, well, they really think that this is about firm value and firm risk and intangibles. And that's our sort of, good answer. And that one, then I would say, well, where was FASB? Because IFRS has actually been disclosing more along the lines of, say, in the US, for example, only 15% of companies are even going to even disclose labor costs. Whereas, like, you look at European financials, you can get a lot more information than you can here. So in that case, I would say, well, where's FASB? And why haven't we been disclosing some of this information that matters to the investors? And then if you take the more cynical view that a lot of people in academia would have, I would say, is that a lot of the investors are driven by marketing concerns, and that they're trying to market to Gen Z and millennials. And so, what their sort of incentives are really just to get increased assets under management. And thus, they have a whole new fan base of potential people who can invest. And so they're just trying to make themselves appealing and want to be at the forefront of that to get more millennials and Gen Z. So, that would be the more cynical view.
Could I just cut in there, Mark? It's often tempting to take an issue like this and describe it in terms of its point in time. And I think that the evolution of the interest in terms of ESG sustainability, I often use instead of ESG factors, but in terms of the interest, it really was catapulted by the investors coming into the mainstream and saying, this is what we want. It was only later that the regulators began to get religion around what disclosure meant to the marketplace and how important it was. The key thrust of Gensler's, the SEC proposed rules is protection of investors, getting investors the information they need to make prudent decisions about investments long term. The EU, on the other hand, is really looking at the whole regulation of companies and funds, I might add, companies and funds in terms of impact, both within the company, what's going to happen to the shareholder price, as well as impact on the environment, the community, the greater world. They operate under their rules. The CSRD operates under a rule of what's called double materiality. In other words, the test of what is sustainable is measured against the impact I generate as a company and the impact that has on the larger environment. But my point really is, it's often tempting to capture these big issues in a point in time when there is an evolution that has brought us to this point. And I think respectfully, it started really with investors, and the regulators have gotten religion. And now we have sort of generational driven points of view, ideas about what corporate purpose is, that's also fueling it. And I think a wider public is now aware, particularly on the climate risk front, that there needs to be something done. Then you've got that. That's the overlay for me, and under it is the corporate purpose issues.
It drives two questions, I suppose, and we can take them in turn. One of them is the elephant in the room, which is regulations coming, and the question of what those are likely to be and where they're likely to come from. That's one set of questions. And the other, the one I'd like to start with, honestly, is that question of shareholders and stakeholders. And, I like the way you talk, Colleen, about FASB and, accounting standards boards. But that question of stakeholders is a new one. Folks who don't have don't own shares in the company, don't work at the company, but are still thought to be stakeholders. And the question is that something that you guys are seeing? And are they, as a group, talking about the larger population around, as a group, is their voice appropriate at the board level? I see everybody staring back at me.
I would just say, I don't think stakeholder is new. I think it's actually quite old. Yeah. I mean, when corporations were originally set up, they were, our first corporations were things like the railroads that were building, public service projects. So I actually would say that we started off with more of a stakeholderism type approach. And then we sort of morphed into shareholderism or shareholder primacy. And then, at least in academia, what we think is coming up next is something that we call sort of productivism, which is to best understand, think of where like Josh Hawley and Elizabeth Warren overlap. And that's sort of what we would consider productivism. And that's this idea of like, there are certain constituents that you should care about and that we should have, favoritism toward, and those are largely employees. And so you see both on the left and the right that you find lots of high profile people that support, say, government intervention into the minimum wage or government intervention to, regarding really anything to create good local jobs. And so I think, there will be, I can see a seat at the table for some constituents. I don't really see a seat at the table for stakeholders more broadly. I don't know how you would administer it. And we've seen it, you can also talk about the corporate law, but it's not like we've never considered this stuff in corporate law. There are constituency statutes that, have not been terribly well enforced. Even with shareholder primacy, it's not that you can't consider other parties. I tend to think when people say stakeholderism, it gets interpreted very broadly. And I understand you want to think about the risk of all the other parties, but to what degree the corporation is accountable to every other party, it strikes me as that's a little bit of a older fashioned idea. I don't think we're quite going back to that.
Alan, what are your thoughts?
Yeah, well, I agree. I mean, I don't think it's a new concept, but I do think there's, definitely with particularly with younger investors, I think they are placing more value on companies that, do pay attention to the other stakeholders, particularly to the employees, to the diversity of their workforce, to the safety of their workforce, to their contributions to the community. And, and so if a boards, obviously then need to start paying attention to that. If that's what shareholders are placing value on, then they need to start addressing those issues as well and seeing how they can improve as a company. And so, I think that's how the stakeholders are becoming more and more a part of the discussion. I think they've always been there, but they're becoming a bigger part of the discussion.
Sure.
Yeah. I think if you unpack what creates value in a company, it helps get at which stakeholders belong at the table. And there's not a set number or a set group that belong at every corporate table. But there are important facets of the corporate enterprise that do have a vested interest in getting from point A to point B, and point B is seeing shareholder value increase. I don't think anyone can argue successfully for a strong sustainability strategy and see that in terms of a choice between shareholder value and sustainability. It's not an either or. They come, in my way of thinking, they come together, part and parcel. And so what's creating that value, what's driving that value is yes, a good CEO and a good management team, a diverse board, in my opinion, a board that understands its governance role and is informed by management, a workforce that is allowed to develop and become even more important to the creation of value. And then you get into the supply chains, the value chain of the company itself. But I think you can get at who is represented around the table by unpacking the value creation.
Well, one more question that I'll ask, and then I'm going to turn this over to the group in the room here, because I'd love to hear your questions for the panel and give you an opportunity to participate. But the last question is the one I mentioned earlier, and that is about, I'll call it regulation or stipulation, comes under a lot of different headings, but the amount of the number of programs that are likely to be suggested or enforced by folks outside the corporation, governments, exchanges, even investor groups. The question is, what's likely to be in the short-term horizon? What do you see? And Alan, I'll start with you. And what are we likely to see kind of longer term?
Yeah, well, I mean, the regulations that I focus the most on are really those coming from the SEC. And, I frankly, I think the SEC is somewhat reluctant to be regulating, issues relating to climate change and the environment through their disclosure rules. I mean, you could see this back when, the Congress passed the rules that requiring conflict mineral disclosure, as a way, forcing companies to disclose their conflict minerals as a way to try to, stop conflict minerals from being mined in certain countries. And I think, there are definitely a lot of people, I think, within the SEC who felt that was not really the appropriate way to address that. If you want to address it, you should go have regulations trying to crack down on that, not through disclosure. So, but the biggest tool that the SEC really has is is telling or trying to lead the companies in terms of what sort of disclosure they're expecting to see. You could even argue that, these climate related rules and, the human capital management rules that the SEC, the guidance that they raised a couple of years ago weren't even necessary, right? Because the SEC has the overarching rule that, company has to disclose everything that's material to the business that an investor needs to know to make make his or her investment decision. And that, should cover everything. And it's up to the companies to figure out what it is that's material. But, through the climate related regulations of the SEC's, basically providing additional detailed guidance about what they expect to see. And that was already foreshadowed. They put out rules in 2010 about, climate related disclosure. They put out, the comment letter back in 2021, the sample comment letter saying these are the types of questions we may be asking to companies about climate related issues. And then now we're going to have the rules that are going to be coming into effect soon. So, they're basically using the tool of disclosure to, try to address these kinds of, social issues, human capital management, and environmental issues. But in my view, at least, I don't think disclosure, if you really want to have an impact on it, you should be, regulating, carbon emissions, not forcing companies, telling them how they have to disclose it. But I'm sure there are people who disagree with that.
Sorry, Colleen, what do you see coming around the bend?
So I would say the former commission was very reluctant to sort of use their powers of disclosure to push through, say, ESG type disclosures. I think the current commission is much more comfortable with it, and I think the future of this sort of climate proposal really depends on what the courts do, and also whether we have a Republican president next. My guess is that obviously we're going to have some sort of climate proposal. If they actually enact the proposal that I think was put out previously, it strikes me as very likely that the courts are going to strike that down and vacate it. Nonetheless, even if they do vacate it, I think a lot of investors are still going to ask for companies to follow it. And certainly, my understanding is that Europe is actually going to be more aggressive. And so if you're a multinational, you've got to do that anyway. Whether this sort of SEC fights it and revises it and we get something else, I think really depends on what the next administration is. Because if we end up with a Republican president, we're going to go back to 3 Republicans on the SEC, 2 Democrats. I think actually there's a good chance that a human capital proposal would still get through and that we could still have some human capital type disclosures. I don't think that a Republican administration will push through a climate disclosure.
I don't think you can take the politics out of it. I really, really don't. It's just the nature of the beast. That said, one of my 2 colleagues on the panel mentioned that a company is not existing in a vacuum these days. So they're going to be impacted by the rules that are on the books here and the rules that are on the books in Europe, in the UK, and then that are being promulgated now by the ISSB, the International Sustainability Standards Board, which is under the IFRS Foundation. And these rules that they are promulgating, they've got 2 out. One is on climate risk and one is on general sustainability issues, are intended to provide a baseline that other regulatory jurisdictions can then build on and add their own requirements for disclosure that suit their business cultures. This is the discussion front and center in Tokyo, in Japan, now with Japanese corporate governance. They've all but embraced the direction of the ISSB and then how to build on that. I think coming back to what we might see in the US and might not see, I think it's quite possible that we could go in limbo for a while, not see the proposed rule not see the SEC staff take the proposal into some sort of formulation that is the rule and put it into effect, it will trigger legal challenges just very, very quickly. There was recently a decision by the Supreme Court, I think in the West Virginia case against EPA, and it found in favor of the plaintiffs, the West Virginia challengers, saying the EPA did not have the jurisdictional authority to promulgate that particular rule for disclosure having to do with climate issues, carbon disclosure, emissions or something. But that issue of whether the SEC has the right to do this or not is one that's going to be debated front and center. And that's why the emphasis in the SEC and on the SEC staff is really on this is information that investors want. And that's clearly in their remit. On the politics in Washington, I'm a Democrat, so I'm delighted with the turn of events last week. But I think that portends much more opportunity for a successful outcome of the SEC's proposed rules than had it been otherwise. If we had a Democratic president and a Republican House and Senate. But all that said, Mark, I really have to say at the end of the day, companies aren't existing in a vacuum. It's coming, some kind of regulation, some kind of insistence that there be disclosure is coming. If for nothing else, we can get to some point of standardization. So there's comparability and there's standardization across the waterfront. I feel like I've talked on and on, but I'll end right there.
I mean, I kind of feel that, BlackRock, Larry Fink's annual letter probably has more impact on company disclosure than, a lot of what comes out of Washington, D.C., because, they're being very direct, saying like, this is what we expect to see. If you don't put this in there, we're going to vote your directors off the board. I mean, that gets up people's attention. As Colleen was saying, the SEC puts out rules that, they might come into effect a year or two from now. If you're a smaller company, it might be even longer. And then in the meantime, they're going to be challenged in court. They may never become effective. So, should I worry about them now? I'll let it sort out. But, these letters from State Street and BlackRock, where they say, this is what we want to see, that's going to have impact just on the next disclosure cycle. And so I think a lot of people are paying, more, almost, or they should be paying a lot of attention to that.
Borrow your microphone if I can, so I can circulate it.
And this is an opportunity. I'll hand the microphone to Nancy. As you have questions for the panel, please raise your hand.
And right before we get to that, for those online, I'm going to try and get in the camera view here. Your special code for CLE is 42176. Okay. Questions?
Thank you very much for sharing your perspectives on ESG. Isaura Garta, Independent Director at Stearns Bank. My question is about board committee work. And you framed ESG as a risk topic, so you could argue it belongs to the audit committee. We talked about governance, and so you could say it belongs in NomGov. And just because of the richness of the topic, you could argue maybe we need to form a new committee specifically for ESG. And then lastly, all board members should be aware of what's happening in ESG. So maybe it's a main board topic. I'd be interested in hearing your perspectives on where does ESG belong?
I can jump in there because I have some firsthand experience. I'm on the audit committee of Quantum Advisors, and then I'm also on the risk committee. And it is in the audit committee that the principal responsibility for sustainability issues. And mind you, there's a mutual fund that we oversee, and there's a major ESG strategy that is part of that mutual fund. Now, there's another board that oversees the mutual fund, the asset management side of the business. I'm on the holding company side of the business. But so in my experience as part of the audit committee, but to a larger point, I think if you're going to have a sustainability strategy, it's important that it be pervasive throughout the company. And that's why people advocate tone at the top, and that it filters down to even the people who come in and tidy things up at night, that they understand that this is a principal emphasis on the part of the company.
Just empirically, they've done a bunch of surveys on this, and they found that it usually does flow through the audit committee. More recently, the sort of people or S part of it has been kind of shifting a little bit over to the compensation and kind of rolled up with that.
That's interesting that you say that. I think the data I saw showed that it was mostly in the nom-gov committee. So I think, what I usually would tell companies is it really doesn't matter which you can set up a new committee, you can assign it to an existing committee. The important thing is that you have to have it in there in some shape or form, that there are a committee or multiple, and some companies actually divided different responsibilities among different committees. Even, sometimes even more than 2 committees might be involved in ESG issues, but you just have to show that you are taking it seriously. You should build it in to your committee charters. You should have language in there specifically referencing ESG and the role that committee is going to play in ESG, and also at the board level as well. You'll have disclosure about what the board's role and first of all, and you have to do what makes the most sense for your company, right? Small companies may not have the people power to be even forming another committee to handle it. So they have to figure out where it's going to fit within their existing committees. But the important thing is it has to be addressed somewhere.
There's no reason it can't be part of the nom-gov agenda like it is part of the audit committee agenda. I mean, what results from the sustainability strategy does have to do with governance. The implementation of a diverse board, for instance, falls directly in the lap of the nom-gov committee. But when I think of sustainability, I do think of it in terms of risk strategy. And I have 3 principal questions that get asked. Are we sustainable now? Do we understand the risks that we face? What's our appetite for the risk? And what do the risks mean for our business? And those are clearly audit committee questions. Typically, the audit committee is going to be backward looking, what goes into the financial statements. But this is forward looking at risk in the future and how you translate that. And there's a whole body of work done here in San Francisco and elsewhere. The sustainability, the Accounting Standards Board, SASB, now part of the IFRS Foundation, the TCFD, all of those frameworks for looking at risk come out of these questions, come out of the industry, come out of what is future risk, and get translated in. And there's a big effort to try to find ways to integrate that into the financial statement so that you have both the forward-looking risk contemplated in your financial statement so that you know what the dollar sign impact is on your value creation. But long-winded answer to the question.
Oh, 1 second.
Hold on a second.
So I think that when I read that, it should say that what you guys have talked about is the theoretical applications, not the practical things. And the first thing is there's around 1,000 public companies that don't have enough money to survive another year. And when I talked to them, I talked about a half a dozen already. They're merrily going on. They can have a few ESG people, but they need a few people that are involved in turnarounds or restructurings or just guys that just pack it in. And, our credit risks are going up and people aren't looking at next year being a year of crises. So I think that for all the ESG stuff, the most practical thing is your company's going to be around. That's the first thing. The second thing, I think, and the Wall Street Journal had a really good article in it. It's energy transition materials. Most of the stuff that's driving environmental is coming from China, all this solar stuff. And not only the Uyghurs, but also they're building like 300 new coal plants. So when you put when you go buy a solar panel or you get an EV car, that's probably contributing to a lot of global pollution.
Well, just
Yeah.
one thing at a time. Let's start with your first question.
Yeah.
The
Okay.
question for the board is, recession is on. How many people think the recession is on right now? How many people in the room? So just about everybody in the room believes the recession is on. How many think the recession will be a bad one? And the question, to paraphrase your question, is what effect will that have as a practical matter on ESG implementation?
I do really not want to do all the talking, but for me, you are not able to divorce the two. They really do go hand in hand. And if you think in terms of sustainability only as a feel good, do good impact, and it's external, not external, but extraneous to really the value proposition, value creation proposition, then it misses my boat, which is ESG is a risk issue.
Yeah, I would also say that, I think, as times get tougher, you will see people get divided more into different camps. You're going to have the camp of directors who feel that ESG is a nuisance and it's a distraction. And all I want to do is the minimum required to comply with whatever the SEC tells me I have to do, because I want to put all our resources towards increasing sales. And then you'll have the other group, which I think, Marcia, it sounds like you're part of, which that ESG is an important thing that is going to, improve the company long term. It should be part of the business strategy of the company, not just something on the side. It needs to be integrated into the business strategy and recognized as something that's going to be valued by shareholders, not just this year, but even more and more into the future. And so it's really going to come down to what the board's belief system is about the importance of ESG. And of course, as you mentioned, it also comes down to resources, right? If you're a company that is struggling to survive, then you're obviously may have to cut down if you have people focused on sustainability, maybe you have to sacrifice them instead of your sales guy or something. So people might have to make hard choices, in order to survive.
But the real second one is the fact that these energy transition materials are so destructive of the environment. Now, there will be a time when EVs will be made a lot more efficient, and we'll have our rare earths mined in the United States instead of China. They'll use batteries that will last for, hundreds and hundreds of miles instead of what they do now. And so by forcing this so fast, you're really causing more problems. You're really, for every guy that's sitting here thinking he's doing something, smoking a plastic straw, that reusable plastic straw, you're really, firing up another coal plant in China. And so I think you've got to pace it until market forces allow that to happen, because the EVs will take over. That if you look at the curve, it'll be good.
I would actually support your notion in the sense that you represent the one camp.
Well, no, it's only, I don't want to see the environment hurt too. I mean, I plan to live a lot longer than, maybe people think. And so I would like to do it. I just don't want to see it get much worse than better. And then the final thing is, I think the war in the Ukraine, as long as the United States not only supplies the bomb, but it's going to have to reconstruct everything, this thing's going to go on. There's a fantastic amount of destruction going on there, and doesn't seem like anybody cares about that. So that thing is going to cause a lot of pollution too.
Let me address the question about recession to Colleen. Is this but is this ESG phenomenon and development, the revolution, some have called it, is it likely to be challenged by a difficult economy? What do you say?
I think it'll be challenged by it, but I don't think it'll be eliminated because I think it's just sort of you separate the wheat, you separate, right? The parts that are important from sort of the fluff. So I think we'll perhaps rethink it, but I don't think it's going to go away. We'll just focus on the parts that are most important. And, one other sort of statistic, but 2020 was the first year that the majority of publicly traded companies in the US reported a net loss for GAAP purposes. For non-GAAP, I'm sure they were all profitable. So there is, clearly information that's missing from GAAP. Those companies are being traded, they have a market cap. I think it's important to really consider what is missing from the financial statements and try to figure out how to actually capture that. And I think those areas will be what will be most likely to survive.
I was in business school many years ago, and a professor of ours at Kellogg told us that the last item on the agenda of the last board meeting of the Good Humor Ice Cream Company was what kind of tires they were going to put on the trucks. 2 weeks later, they went chapter 11, and that was the end of the Good Humor Ice Cream Company. That question of practical application of important concepts to companies that have obligations to keep themselves going is at least an interesting question.
Hello, Britta Baumhard. I'm an independent director at Primo Waters. I'm actually on their ESG committee. We have 12,000 employees, and I'm a former EVP of Arm & Hammer. So just to give perspective, I want to be the other voice here and saying ESG is vitally important because since we started our ESG journey and particularly looking at the diversity and the inclusion aspect, you can imagine if you have 12,000 employees, people retention is a huge issue. So that's been a very, very positive builder in improving our metrics and therefore also improving the financials because every recruitment is important and expensive. But actually, I wanted to come back and I like Gary's question about the practical applications because one of the topics we struggle with is actually how to get the right data and the right kind of understanding of the ESG impact of all the operations. And I wondered whether there's actually any insights you can share because we are struggling with the data and second, to what framework should we map it to? And I'd be very interested in your point of views here.
Yeah. I would suggest having a hard look at the SASB framework, now the IFRS Foundation framework. They merged in June because that framework is industry driven. And the metrics that you are asked to disclose against are metrics that come up out of the industry and they reflect the industry. In other words, you'd be looking at a metric that asks for the carbon emissions if it's an energy company. But if it's a financial services company, the emphasis might be elsewhere than emissions. But the SASB standards and also the TCFD on climate can be helpful, but particularly the SASB. I'm most familiar with SASB.
That's a question, by the way, that you asked is very much in the literature. What are the right ways to measure ESG performance? And your second question, what metrics do you apply? What scale do you apply against those metrics? Alan?
Yeah, well, I mean, just to echo what Marcia said, I do think those are the two standards that, that the majority of companies are applying, the SASB and the TCFD. So I think in terms of reference points, how you measure the data, how you get at, I mean, those are kind of issues that I don't usually get involved with as a outside counsel. But one of the things, this may be obvious, but take a look at your competitors, right? See what they're disclosing. I think, the way this is all progressing is, companies are looking ahead, but they're also looking sideways. Nobody wants to necessarily get too far ahead of the wave and But you also don't want to fall behind what your competitors are doing. So I would, definitely have people on your team that are constantly looking at, what your main competitors are doing in terms of disclosure, what kind of metrics they're disclosing, because you are going to be measured against them. And then if you see that they're disclosing numbers and you're scratching your head like, why, how are they even coming up with that? That's a problem, and there are plenty of advisors out there who are willing to take your money and help you come up with that kind of data. But data is really going to be one of the key points as we go forward that people are going to need to focus on, both in terms of how you get it, but then secondly, how can you as a board or the CEO, CFO, be confident that that data is reliable, right? Because ultimately they have to sign those certifications, saying that there's no material misstatement in the disclosure. And so that has to be built into, your disclosure controls and procedures, and you should have, people scrubbing that data to the same level that they're scrubbing the data, your financial related data. I didn't really answer your question, but
my observation before we go to Colleen is that I was astonished how many professional services firms now have so-called ESG offerings. Audit firms, law firms, management consulting firms, systems integration companies, even recruiting firms like ours are offering to do assessments of some of the human capital metrics. And I wonder, to your point, Alan, some of them seem like they're pretty qualified. Some of them have, see it as a business opportunity. I wonder, Colleen?
Oh, I mean, I think my colleagues mentioned the main frameworks. The only thing I would add to that really would be, if you haven't already, which I'm sure you have, just asking your lead shareholders what they expect you to report in accordance with. And as for the data, I can't tell you how much I hear this. And I know there are a number of sort of startup-y software companies working to try to get some sort of system so that companies can actually report this. But right now I'm not aware of any that really can do what I think you probably want them to do.
There's a very exciting company in Cambridge, I think it might be Boston, called Novata.
Yeah, I know.
And they are a technology company. They have a platform, and if you come to them, they will help you get at the data that you need. That's as much as I can tell you what they do. In a couple of weeks, I'll know a little bit more. I just wanted to add something to what you were saying, Mark. Another piece of the industry that's evolved is this third-party assurance piece, where there are companies that are nonprofit as well as for-profit. I was talking to a nonprofit called Blue Mark, I believe. Is that right? Blue Mark, it's a subsidiary or a sister of Tideline, but they do nothing but third-party assurance that the data in your sustainability report goes to the issues that you're disclosing about. And then, of course, all the audit firms do that particular thing. And that third-party audit is addressed in the proposed SEC rules as well.
I just have one quick anecdote about the ESG assurance. So I remember looking up the guy who does the assurance at various points for Alphabet, for Amazon, for a bunch of the companies here. You look him up on LinkedIn. His first job is actually at a veterinarian's office where he works part-time. And then his second job is something like a sound system. And then when I looked up to see what that was, he's a nighttime DJ in Oakland. And so we're talking about a very different world than the typical sort of stereotypical Big Four kind of auditors. It's a really fun space.
By the way, that could touch on the issue around employee morale. Maybe that was part of it. Question?
Hello, I'm Susie Taharian. Just quick background on me. I'm a CFO of a company called Expansive, which is the world's largest online exchange for carbon offsets. And then I'm also on the board of a SPAC. So I'll just give you the perspective from both sides of that. We talked about whether a recession would have an impact on ESG behavior. So in 2020, we had COVID, right? A huge impact and saw a huge drop, economic drop, whatever measure you look at. during that year, the volume of carbon offsets that went across our exchange tripled year on year during the huge economic downturn. The next year, it quadrupled. So what we're seeing is that recession is not having that impact. Now, I think for the bottom 1,000 who's going out of business next year or next month, probably not. But for the rest of us, it's not impacting the way you'd think. The other thing I'm seeing, the reason it's not having that impact is because the driver is not regulatory or SEC. The driver is financial institution investors, as Alan pointed out. It's BlackRocks of the world. It's investors and shareholders demanding it, not caring what SEC says or doesn't say. So after the Global Climate Summit last year, a bunch of financial institutions got together and said, we want to drive net zero. The total asset under management for those financial institutions is $130 trillion. That's what's pushing this, right? Doesn't matter what, SEC has done nothing, right? And even with the SEC or EPA doing anything, the volume of carbon offset trading is growing very rapidly. So that's $130 trillion that's pushing this. Our company was looking to go public this year. We saw the public markets, we pivoted, and we got financing from Blackstone instead. So it's the likes of Blackstone and BlackRock and others who are very much behind this. So today, if you're trying to raise money, debt or equity or have existing shareholders, they're the ones who are going to come ask for it. And I see this the same thing on the board of the SPAC I'm in. It's as we're looking at investment, it plays into it. Not so much because honestly, it's not that everyone's trying to do good. I think they're just thinking financially it's the right thing because the carbon transition or energy transition is going to be huge, and they see it as a huge financial opportunity.
If I'm not mistaken, the carbon trading mechanism is one of the principal things to come out of COP27, right? Some regulation that all signatories can agree to on how the things get traded cross-border. Is that right?
There is a regulated energy emission commission, emission trading. Excuse me. There's a regulatory emission trading. There's also a voluntary carbon market, which is what we're in. Okay. And what comes out of COP27, 28 is going to push even more towards what's called voluntary. But all that means it's not regulated, but it's driven by these financial forces, so it's not really voluntary. But yeah.
If I might, how do you address the criticism of carbon trading, that it's just a matter of shuffling the pucks on the shuffleboard? It's not really reducing the amount of carbon in the
So great question. So in the emission trading, which is regulated, it's exactly that. It's a government saying only $100, and you and I can push them back and forth. In the voluntary carbon market, what is happening is essentially I'm funding a reforestation project. I'm funding new solar energy. I'm funding a wind power project. And so you're actually net improving, net reducing carbon emissions somehow. The key part of it is quality control, and this becomes really important. And this is why you want to have reputable technology and certification and validation and auditing process to make sure that people are actually paying for the right thing.
Others?
Hi, my name is Anne Lucena. I'm in my career, I've been a hospital CEO for a number of years, and then I serve on a board of a biotech company called Cirrus. It's a public company. My question is, it seems like what you incentivize is always what happens. So have you seen anything effective that boards are doing in terms of creating incentives or some performance metrics for the management team to reward or encourage them to deliver, effectively on ESG goals?
Question. Alan, what are your thoughts? Have you seen that implemented in companies you work with?
Yes. I mean, that usually is when you're getting into larger companies, right? That will have like a separate team working on sustainability. Then, as with any employee, you'll have certain targets that they should meet to get their bonus for the year. And I think that's generally how companies are addressing that. If that's part of your if that's part of what your role at the company, then that should factor into your bonuses. But yeah, so I have seen companies do it, but nothing. I haven't seen them offer like anything outside of that.
It's an interesting question because it touches on the thing that you talked about, Marcia, which is what the boards do is interesting, but ultimately those plans need to be implemented by the management team. The question of how to incent them, how to describe their goals and make those goals clear it's a pretty interesting question.
Yeah, I mean, I guess you could also apply that to bonuses for, CEO, CFO type roles, but I haven't really seen that, to be honest. It's more about the people whose specific role relates to those types of goals.
Alan, I'm trying to recall the name of the company, but it's a Fortune 200 company that has recently taken the incentives all the way down. In other words, the incentives were built into the comp structure for the leadership, but now it goes all the way down to staffing. They are integrating their sustainability strategy so thoroughly that they're incentivizing in that way. But I have it in my notes. I can look it up and tell you afterwards.
Before we go to the next question from the crowd, let me ask a question of the panel. You alluded to this twice, Marcia. You said that ESG companies often are incented by the bottom line, and by ESG companies are performance companies. Is there evidence that companies who perform well on the ESG programs, who are bold and who are out in front of the ESG issue, is there financial evidence that they outperform their peers in the market? I see Colleen smiling, so I'm going to ask her first.
So, is there good causal evidence? No. Is there correlational evidence? Yeah. And that's, the problem, but I don't know, given that we have really poor ways of measuring ESG and that it is, to use our sort of favorite word, endogenous, meaning that companies that say have more money are more likely to engage in these ESG programs. And thus, if you run a sort of study and it's like, oh, high ESG, also high value. And it's like, yeah, well, maybe they had the money, so that's why they did it. So you can't tease out causality, and it's just from like an empirical standpoint, that's not going to happen. Is there correlational evidence? Yeah. Is it, but it's a correlation.
Understand. So the answer is not yet, but it sounds like an area that will be examined in the future.
I think if you look to George Serafim's work at Harvard, he has done a lot to put dollars and cents to the value that's been created as a result of sustainability strategy. Can I quote you chapter and verse? No, I can't.
As a result of ESG.
So
it is causal.
I know George's work. I wouldn't say it's causal.
How would you describe it?
I would describe it as I think he has a strong point of view that, and I love his work. But certainly in academia, we wouldn't describe that as really strong causal evidence. I think I think his work is great. I don't mean to be disparaging of it, but I wouldn't call it like, and if you look at the entire body of research, George is one person. There are plenty of people who find things on the other side.
Yeah, I appreciate this distinction between causal and correlation. Because at the end of the day, you're talking about risk that's in the future.
Yeah.
So it's very hard to say, what are the dollar and cents? What's the value of that? Although there's that effort being made to do that now.
Alex Edmonds actually at LBS has some really good stuff. And I'd say he gets the closest to finding nice, like actual causal work.
Sorry, there was a question for the audience.
Yeah. Hi, Neil O'Callahan, Deloitte. Mark, thank you for showcasing the PwC study. Maybe next time. But question I have, I'm on help run our marketing programs with the C-suite, and we do a lot of CFO forums and such. And one thing I'm wondering is, and maybe with large cap, there might be a chief sustainability officer and a sustainability team. But say, for instance, with mid caps, are boards really comfortable in expecting that CFOs and finance teams are going to be able to really accurately report and give the board the information they need. And so I'm just maybe a two-part question. If you don't have a sustainability team, should it be housed with the CFO? And to what degree are boards comfortable with the finance teams tackling the SEC requirements and such?
What operational groups does sustainability belong?
So I do some work with portfolio companies and on their sustainability strategy. And my partner and I make a point of, when we go in, really evaluating where that startup is, usually a late stage company, where that company is in terms of its sustainability / risk management. And we gear the strategy then to where they are in that process. And it might be purely educational at that point, but what drives it is the belief that good governance leads to a stronger exit. That's what's really driving it. So in other words, it's tailored. There's not one rule of thumb that applies to all companies. Every company doesn't need a sustainability officer, but every company, I think, public company and private company increasingly has an awareness of the importance of sustainability, again, as a risk matter, and will incorporate that in some way, shape, or form. It has to be, I think Alan mentioned this, it has to be suited to the company. It really is the company's characteristics, the company's culture, the company's values that drive that application.
It makes sense that Neil from Deloitte would suggest it's in finance. If there's anybody here from Mercer, maybe we can talk about human resources instead.
Well, I think just in terms of putting together a team, it should be cross-functional, right? Because as we talked about, ESG spans so many different things, or it could span different things depending on your company. So usually it'd be, somebody in finance to kind of tie it to the financial statements. Usually somebody in HR, because you have to deal with human capital management type issues. If you have somebody in supply chain, that could be an important thing for your company to have somebody on, looking at supply chain issues. Operational person, how can you, decrease your use of water, or decrease your use of energy at the company, or that's the team that needs to then get together, and also probably somebody on IR too, right, who's getting input from shareholders about the things that they care about. I think Colleen mentioned that's a critical part of it, right? Is that, as we've been talking about a lot, this is very much investor driven. And so a company's disclosure is really, a large part of it is you got to present the data that your investors care about. Like, why spend time and resources, gathering data on something that your investors don't actually, place value on. So you want to get those people together and then just have them brainstorm about, okay, let's look at this big, put on a blackboard, a list of, 20 or 50 different ESG related topics, and then start thinking about, well, which one of these are relevant for us? What are the most relevant for us? What are we doing that's good? What are we doing that's bad? What can we do to improve? And that's going to be the start of the beginning of, your ESG related policy. What sort of things is your company going to focus on? What are you going to tell people that you're planning to focus on? And then how are you going to be able to support any of this with data? And maybe you can't, but maybe you can still, maybe it's still valuable to say that, hey, we think this is something that's important to our company, even if you can't measure it. And then, and then on top of that, if we're talking, this is all in the context of disclosure. How are you going to back up that data? How are you going to be able to tell your CEO, CFO, yeah, these numbers are correct? Because they're going to have to sign that annual report and saying there's no material misstatements. So what sort of controls are they putting in place around that data to make sure it's correct? So, I mean, these are kind of the steps I would see that companies need to go through to be able to come up with, number one, the policy, and then number two, the disclosures that they're going to present to the market.
Colleen? Well, look, folks, we've got just a little bit of time left, and I'm going to suggest that we take one more question from the crowd, but I'm going to ask the panelists at the end to give all of you as board members a suggestion, just to prepare them. You know, one thought about what to carry into your next board meeting, and that could be both helpful and conducive to your role as a board member. But one last question from the group, if we can.
I don't know if you want to end on mine exactly, because I'm going to say something maybe provocative, but I'm Amy Schenken, and I'm an advisor to a private equity firm and serve on both public and private equity owned boards. But I find myself, having listened to a lot of conversations about ESG, I don't know if it's a marketing problem or a more substantive problem, but I almost wish the term would go away. Like when at the start of this, you talk about, you know, you raise a question mark, what is it? And I think, sorry, Marcia, you said it's risk, right? Well, we have enterprise risk management, and it includes things that are beyond ESG. And then Colleen, you talk about, I thought it was very interesting, you talk about it being the stuff that's not showing up in your financial statements, the intangibles. Well, brand is a intangible, and it's not part of that. And I sort of feel like we're contorting ourselves to figure out, you know, who should run this, which this is ill-defined, and where it sits in a committee, which is really all of them potentially. And so I just find myself wondering, like, how does this just get sort of blown up and put back into, let's talk about the environment, let's talk about talent, let's talk about governance, let's talk about enterprise risk management. But I feel like there's a disservice going on here talking about ESG, and I'm wondering if anybody has the same kind of feeling as they think about this topic.
I absolutely do. Yeah, I feel the same way.
There was about a month ago, maybe 2 months ago, there was a terrific expose in The Economist, and it took a lot of the ESG falderall to task. And it said at the end of the day, ESG is just too big a term. It's too complex. Let's just talk about E, and then let's just talk about climate risk as it applies to E. And then if you want to talk about the S, the aspects of that, but to break it down, instead of having this big basket, let's have mini baskets.
Well, you have to, right?
Yeah.
Any company that's looking at it has to break it down, because they're different things.
Napoleon said that the power to name something is the power to destroy that thing. And I feel the same way you do, that the term ESG is unwieldy, and frankly, it's kind of a red herring for many of the people who are genuinely trying to do the right thing.
Yeah.
All right, with that, let me ask each of you, and I'm going to start with you, Marcia.
Okay.
If there's one thing that you're going to ask these folks to carry into the next board meeting, what is that one thing?
I would suggest taking to the board the question, do we understand our risk appetite? Do we understand the risks that we face, and are we able to withstand those risks in terms of delivering shareholder value? And by risk, that umbrella includes sustainability factors as they apply to the industry we're in.
Alan?
I would say a good question is, who's in charge of this? Who's taking responsibility for this within our company? Both at the committee levels, as we talked about, but also at the working group level. I mean, can't be done by the board, right? There has to be people at the executive level that are, putting these policies together to present them to the board. And who are those people? Is it the right group of people? Do we need to add to that group, either externally or from other people within our company?
Colleen?
We haven't discussed the political backlash at all yet, so I'll mention it here. We have seen, for example, I think it was just last week, there were 5 Republican senators who sent a notice to a bunch of law firms saying that they were going to look into antitrust issues with respect to ESG. Obviously, we saw Ron DeSantis. I would understand, so just looking at the physical space in which you're operating and the sort of politics that are involved there. And using that as also when you think about which types of ESG you are sort of focusing on publicly, just reality of considering the political environment.
Well, I want to thank our panel today. Wanted to thank Colleen and Alan and Marcia for being here. You guys are amazing.